Good afternoon. My name is Ward Keever. I am the founder and CEO of Covenant Wealth Strategies, and I'm joined this afternoon by Michelle Fisher, part of our leadership team here at Covenant. Today is Thursday, January 19th, 2023, and this is our Stone Barn Speaker Series virtual edition. So we are delighted to have with us today David Lebovitz from JP Morgan Asset Management. He is the recently promoted Managing Director of Global Market Strategies at JP Morgan, and reports to a friend of mine who I've known for many years there at JP Morgan, David Kelly. So we're excited to have David with us today. Since joining the team at JP Morgan, David has helped to build out the Market Insights program, both in the United Kingdom and throughout Europe, and has appeared on Bloomberg TV and CNBC, and is a frequent financial contributor to various media publications. David joined JP Morgan in 2010, and prior to that was a research analyst at Cobran Insight Management, where he was responsible for small and mid-cap equity research, working alongside the CIO to construct model portfolios. David obtained his BA in political science and philosophy with a concentration in leadership studies from Williams College in 2009, and earned a dual MBA degree from Columbia University and the London Business School in 2015. David and his wife, Christy, live with their two daughters in Connecticut. Their youngest, just born 3.5 months ago. I mentioned to David as we were preparing for this that it looks like he's getting plenty of rest, and I'll let him tell you all about how to teach a 9-week-old to sleep through the night. So, but David and his two girls and his wife, Christy, live in Connecticut, and living in England for quite some time. A fun fact is that David thinks that football, you're not allowed to use your hands. But he does assure me that he is an American football fan as well, and I have some inside intel that says that he is a Boston fan, which would mean New England Patriots, and the Boston Bruins. I understand also, David, you're quite a hockey fan as well. So before I turn it over to David, I will let you know that we will do Q&A. You can submit your questions at any time to Michelle at covenantwealthstrategies.com, and we will hold those until the end, and then we will queue those up for David. And David, if you and I want to chat a little bit during the presentation, that's fine, or I can hold my own questions until the end. So we'll see how that goes. But without further ado, I'd like to turn it over to David, and we're excited to hear what you have to share with us today, your guide to the markets 2023.
All right, excellent. Well, thank you for the introduction, and good afternoon, everybody. Happy New Year, and I hope you're all doing well. It's interesting. So the 3.5-month-old daughter is managing to sleep through the night. It's the 3.5-year-old daughter who has found a new obsession with waking up in the middle of the night and coming to visit us. Which has certainly been an interesting couple of weeks. But nonetheless, it was an interesting year in the markets in 2022. Certainly had some things sneak up on the market during the night, which led to a very challenging year. But we think that 2023 is going to look a bit better. And so what I wanted to do this afternoon is start by talking a little bit about our views on global growth, spend some time on the risk of a recession. What's the probability? Are we in one today? What could one look like if and when it does materialize? I'll then spend some time on inflation and what that growth and inflation backdrop may mean for monetary policy and the Federal Reserve. And then I'll shift gears and I'll talk a little bit about what all of this means for capital markets and portfolios before wrapping with a few thoughts on volatility, long-term opportunities that have been created, as well as the importance of staying balanced. And so we want to dive right in here on page 2 of the presentation, just starting with a 20,000-foot view of the world. What we're looking at here is an economic indicator called the Purchasing Managers Index, or PMI. Now, these PMIs tend to track the overall pace of economic growth fairly closely. We are looking at the composite figure on this slide, So taking into account both manufacturing as well as services. And what you need to know about the PMIs is that 50 is the key level, which separates expansion from contraction. So anytime you see a PMI above 50, it means an economy is growing. Anytime you see a PMI below 50, it means an economy is shrinking. But for the purposes of this chart, we're showing things as a heat map. So green means good and red means not so good. What jumps out at me when I look at the far right-hand side of this slide is really how the growth profile of the global economy has changed over the course of the past 6 or so months. And if we were to go back to the summer of 2022, the heat map looked a lovely shade of green. What we then saw was that as the leaves outside began to turn in the fall, the heat map began to turn a shade of yellow and orange as well. And then you look at the far right-hand side today, pretty much every PMI that we show on the page across the developed world is below that key 50 level. And you can see a lot of red, a lot of orange, not a whole lot of green. And so as we've seen this deterioration in the overall pace of growth, the question of recession has come up more and more in our client conversations. And the first thing I'll say about recession is that it's always a question of when. It's never a question of if, but a lot of people have said to me that they think we're in a recession today, and that is certainly not the case from our vantage point. If we flip to the next slide, it's interesting because if you were to go into a bar or stop somebody on the street and say, what's the definition of a recession? They would probably say 2 back-to-back quarters of negative growth. But it's actually a little bit more involved than that. There's a group of individuals that sits in Cambridge, Massachusetts. They're called the Business Cycle Dating Committee, and they exist within the National Bureau of Economic Research. This Business Cycle Dating Committee, they are the scorekeepers on recessions. And when they think about recessions and call recessions, they look at the 6 variables that we're showing on this slide. Things like personal income, employment, consumer spending, wholesale and retail sales, and then industrial production. We're showing those variables as a heat map up at the top, where red would designate a recessionary level. And then down at the bottom, we're showing the rate of change in these variables over the course of the past 6 months. What's clear to me is that we are not in a recession today, right? Growth is slowing, but we are not in a recession. And furthermore, when we think about the probability of recession this year, one of the things that keeps us 50-50 here in the United States is really the strength of the labor market. You look at the employment situation today, you have an unemployment rate of 3.5%. You have wage growth that's decelerating on its own. We think that the labor market is going to remain healthier than some other people expect over the next 12 to 18 months. And that well may be enough to help keep the US economy out of a recession, which has become, the idea we have a recession has become increasingly consensus over the course of the past couple of months. But if we flip to the next chart, again, recessions are always a question of when. They're never a question of if. And so it is important to entertain, what a recession might look like if one were to materialize over the course of the next 12 to 18 months. And, when we think about what really drives recessions, it all comes back to the most cyclical parts of the economy. So what we're showing here are the 4 most cyclical sectors here in the United States. Effectively, these 4 areas of the economy have been responsible for all of the booms, but also all of the busts that we've seen since World War II. The way I think about this chart is you have consumers on the left-hand side with housing and autos, businesses on the right-hand side with investment spending and inventories. And again, nothing on this chart looks terribly off sides. You look at investment spending or housing, both of which we show as a share of GDP. Those are right in line with their long-run averages. You look at vehicle sales down in the bottom left-hand corner, sitting below its long-run average. You look at inventories. Inventories have been trending higher. We've heard from Target, we've heard from Walmart, we've heard from Amazon. They have too much stuff, but that is very much a flashing yellow light. That's not necessarily a red light. And so if we have a recession here in 2023, we think it's going to be average. We think that people are suffering from recency bias after 2008 and 2020, and they're assuming that any coming recession in the United States is going to look, feel, and smell like the past 2 times around. Those were very much outliers. And again, we think that any recession were to materialize this year would basically fall in line with what we've seen on average over time. Now, if we flip to the next chart, what's so interesting about the current environment is that against this backdrop of slowing economic growth, inflation has remained extremely persistent. This is our inflation heat map. Red is hot, blue is cold. You look at the far right-hand side of the chart today, and you can see that the majority of the squares are still a fairly deep shade of red. We do think that inflation has peaked in the developed world. We think that particularly in the US and in Europe as well, we've seen the high watermark for inflation this cycle. But we also recognize that it's going to take time for inflation to come down to where the Fed would like it to be. And we're really watching three things to gauge that trajectory of inflation going forward. The first thing we're watching is what goes on in China and the impact on supply chains. The second thing we're watching is what goes on in the labor market. And the third thing we're watching is what goes on with housing. Just quickly on China, China has reopened their economy. The virus is absolutely ripping through the population as we speak, which is very unfortunate from a social and a health perspective. But it does mean that the back half of this year should be better for the Chinese economy. And what we're most focused on is whether or not they start instituting lockdowns. You know, we see factories shut down, if we see villages locked down, that's going to lead to disruption in global supply chains. That's going to lead inflation to take longer to decelerate than what we've currently penciled in. It's not our base case that China goes back to the approach that we saw during the early stages of the pandemic, but we can't completely write off the potential for them to do that over the course of the next couple of months. If we flip to the next chart, the second thing we're watching is what goes on with the labor market. And you can see here, the gray line represents the unemployment rate. The blue line represents wage growth. As the unemployment rate has fallen to a level of 3.5%, wage growth accelerated to its fastest pace since the late 1970s and the early 1980s. Now, you're seeing signs that wage growth is rolling over, but wage growth still remains fairly robust in the lower income portions of the labor force. And this is what the Fed is worried about, because those lower income individuals have what is called a higher marginal propensity to consume. Put differently, if they have an incremental dollar in their pocket, they are more likely to go out and spend it as opposed to save it or invest it. And so what the Fed is worried about here is a wage price spiral taking hold. Again, the labor market is cooling off as we speak, and we think that wage growth will continue to decelerate over the course of the coming months. But the Fed, again, is laser focused on that relationship between wages and prices, which will continue to impact the trajectory of inflation going forward. And then the third thing, if we flip to the next chart, is what goes on with housing. So big moves in home prices only show up in things like CPI with a lag. And what we've done on the chart on the left-hand side is decomposed the year-over-year change in headline inflation into a variety of different components. And if you focus on those dark blue bars at the bottom, that represents the contribution from shelter. Now, the way that shelter inflation is calculated is really twofold. One is based on observable rents. The other is based on a concept called owner's equivalent rent, which is basically what I would rent my house for. But here's the interesting thing. I don't rent my house. I live in my house. And so owner's equivalent rent is very much a nebulous concept, almost like an invisible enemy, if you will. And one of the things that we're going to be watching closely is whether or not the Fed can differentiate this housing inflation, which is very slow to move and is going to limit the speed with which inflation can decline this year, whether the Fed can differentiate that inflation from inflation that's coming from the other service-oriented areas of the US economy. And so if we flip to the next chart, there are significant implications of this backdrop for the Fed. When it comes to the Fed, I think the most important thing to recognize is what we show over on the far right-hand side. The blue dotted line represents the Fed's estimates for where they believe the funds rate will be at the end of the next few years. And then that green line represents what investors are expecting the funds rate to be, again, at the end of the next couple of years. And the Fed has said, we plan on taking the funds rate north of 5% and then leaving it there, at least through the end of 2023. The market, on the other hand, believes that the Fed will continue to hike here during the first part of 2023, but then begin cutting during the second half. And I'm not buying what the market is selling. I think that the bar for rate cuts remains extremely high. I think the Fed wants to be beyond confident that the inflation genie has been put back in the bottle before they begin to ease monetary policy in any material cut type of way. And so I do think that this will likely be a source of volatility as we think about 2023, but I'm taking what the Fed is saying at face value and very much believe that they will move rates above 5% and then leave them there for effectively as long as they can. So if you think about the macro backdrop, it's kind of interesting, right? We have slowing growth, persistent inflation, and monetary policy that continues to tighten. This has created a lot of risks, as we saw in 2022, but it's also created a handful of opportunities. And if we flip to the next chart, one of the opportunities that we see in the current environment is actually in fixed income. You know, I've been at JP Morgan this is my 13th year. I'm not sure we've ever talked about owning fixed income for the income, right? Because rates have been at zero for the better part of the past 15 years. What we're showing here on this chart, the blue diamonds represent the current level of interest rates. The gray bar represents the range of rates over the course of the past 10 years. And then the purple bar represents the median yield, again, over that same period of time. We have high quality bonds on the left, lower quality bonds on the right. And what jumps out at me is that when you look at the chart on the left-hand side, those blue diamonds are sitting near the tops of the gray bars, right? High quality bond yields are sitting near the high of their 10-year range. And so we like the idea of maintaining a higher quality bias within fixed income. We like treasuries, we like munis, we like parts of the investment grade credit complex, but we're not quite there on taking a whole lot of risk in fixed income. And so while there will come a time to step into things like high yield and emerging market debt in a little bit more of an aggressive way, I think that there's probably a little bit of a re-rating in valuations that needs to occur before we're willing to take that leap of faith into the extended parts of the fixed income universe. And so we're finding things to do in the bond market. If we flip to the next chart, we're also finding things to do in the equity market. Now, 2022 was a year where valuations really drove all of the market action. And a lot of people believe that 2023 will be all about earnings. You can see those blue bars over on the left-hand side represent earnings estimates for 2022, 2023, and 2024. And while we are seeing a decline in profits last year, we did see a decline in profits last year, expectations for 2023 remain entirely too robust. You know, consensus is looking for kind of mid-teens growth in earnings this year, and that's something that we just don't see playing out given our broader macroeconomic view. So what will earnings actually look like this year? Well, the first thing we should do is adjust based on, you know, tendencies of analysts to over or underestimate earnings. And you can see in the chart on the right-hand side that at the start of a given calendar year, analysts are usually overestimating earnings by about 5.5%. So the first thing you should do is take that $225 a share number and take 5% right off the top. That brings your growth rate down into the mid to high single digits, which we still think is a little bit of a stretch. Our base case assumption here is that if the US avoids a recession, earnings are probably flat. If the US goes into a recession, earnings are probably down 10 to 15%. But we can't get all the way to a significant, say, 30% collapse in profits over the course of the next 12 months. And the reason why is that inflation actually works in favor of profits because it helps support revenue growth. It helps support the top line. And so we'll need to see this re-rating in earnings expectations, but I'm not sure that the earnings story this year is going to be quite as bad as some people on the sell side have suggested as of late. Now, if we flip to the next chart, you know, we're also seeing opportunities outside of the US. But before I talk about opportunities outside of the US, I think it's important to take stock of our view on the US dollar. So the dollar basically went straight up in 2022. It began to cool off into the end of the year. Frankly, I think that the dollar is going to remain range bound for the next couple of months as we figure out what the Fed is going to do, what's happening with economic growth. It's going to be a tug of war, and I think that that's going to keep us within a relatively tight range. But in the long run, we have a lot more conviction around the direction of the dollar. And in the long run, what we've seen is that currency performance is really all about a country's trade balance or current account balance. And As you can see in the top right-hand chart, the US runs a chronic current account deficit. So put differently, we are a net borrower of dollars from the rest of the world. And what this means is that over extended periods of time, the dollar should be getting weaker rather than continuing to get stronger. And so, put differently, if we flip to the next chart, we believe that what has been a headwind for non-US investments over the course of the past 10 to 15 years should evolve into more of a tailwind over the course of the years to come. And when we think about the international thesis, it's not just about currencies outside of the US looking cheap, right? It's also about the equities themselves looking cheap. As we show in the chart on the left-hand side, non-US equities are trading at nearly a 30% discount to their US counterparts. And then as we show in the chart on the right-hand side, they pay you nearly 2 percentage points more in dividend yield than is the case in our own backyard. And so the currencies look cheap, the equities look cheap, the dividend is more attractive. To me, is 2023 going to be the year where international outperforms? Your guess is probably as good as mine. What I do believe, however, is that over time, the pieces have fallen into place for international equity returns to be at a minimum more competitive with the US than they have been over the course of the past couple of years. So if we flip to the next chart, just to wrap up here with a few thoughts on volatility, long run opportunity, and the importance of staying balanced, 2022 was an awful year. What we're showing here are the annual returns of a 60-40 stock bond portfolio. You can see that 2022 was the worst year for a 60-40 portfolio since 2008. And prior to that, you had to go all the way back to the mid-1970s to find comparable performance on the downside. 2022 was a challenging year. It was an uncomfortable year. It was a difficult year. But it's important to remember that volatility creates opportunity. And if we flip to the next chart, we've quantified that opportunity over in the chart on the left-hand side. What we're showing here is the average annual return that you would stand to experience if it took 1 year, 2 years, 3 years, 4 years, or 5 years for the market to get back to the peak that we saw in January of 2022. Let's just say it takes 3 years to get back to the peak. You would stand to make 8% a year over those 3 years, which is a completely different conversation from the one that was being had at the start of 2022, when frankly, all assets, stocks and bonds, were looking rather expensive. And so on the back of this volatility, there has been an opportunity that's created. But it's important to remember that markets look forward. If we flip to the next chart, what we're showing here are during 9 recessions since 1960, the path of the S&P 500 in green and the path of the unemployment rate in purple. The punchline here is that on average across these 9 instances, the S&P 500 bottomed 6 months before the unemployment rate peaked. Markets look forward and will begin to price in a better tomorrow in advance of it showing up in the actual economic data. And so if you're waiting for the data to look better, feel better, smell better before you put money to work, the reality is that the train will have left the station, and unfortunately, you will not be on it. But in the long run, we all know that it's about time in the market, not timing the market. And if we flip to the next chart, we also know that the best approach over time remains one characterized by balance. What we're showing here are the annual returns across a number of different asset classes over the past 15 years, alongside a balanced portfolio comprised of those different asset classes, which is the gray box connected by the black line. You can see that balanced portfolio, it's never the best performer, but it's also never the worst. It trends right along the center of the chart, providing clients with a smoother ride over time. And frankly, I'm a big believer that if we can keep the ride comfortable, then we can keep people invested. And if we can do a better job of keeping people invested, we can subsequently improve the chances that they successfully accomplish their long-term financial goals. So with all that said, I'd like to thank you very much again for your attention this afternoon. I will pause there and turn it back over to the team, and I'd be more than happy to take any questions in the time that we have remaining.
David, thanks so much for your presentation. And just a reminder for those participating, you can send your questions in by email, Michelle with 2 L's, at covenantwealthstrategies.com. And while we're gathering those questions, I had a few thoughts on your comments and then a few questions of my own. So I thought your comment was great. Volatility creates opportunity. We like to say change creates opportunity. And certainly there have been changes and there have been volatility. And so we do see opportunity there. David, a question that we get from time to time, and you mentioned China reopening, and kind of a little bit of a debate, if you will, but is China reopening, is that inflationary because you have an increase in demand from their reopening, or does it maybe help mitigate inflation because supply chains are improving as they're reopening and entire cities are not shut down and factories are working? So do you see it more helping or hurting from an inflationary standpoint as China reopens?
I think on a net basis, it will help more than it will hurt. You may see some upward pressure on certain commodity prices as China comes back online, just given the share of commodities that they consume globally. So things like iron ore or copper, I would expect those prices to rise a bit as China comes back online. But I think the overwhelming impulse will come from the lack of shutdowns and supply chains that function in a bit more smooth of a way. And so I think that China reopening is a good thing for the inflation story. I also think that China reopening is a good thing for the economic story, because if the China economic engine really kicks into gear during the second half of 2023, that could be a powerful tide that lifts a whole lot of ships across different parts of the global economy as well as the capital markets.
How do you think supply chains are adapting or flexing? Specifically, China did go through several years of shutdowns. There were individual companies that were in the press for shifting their supply chains, and a number of companies have begun shifting supply chains to other countries, such as India, most notably, but also to a lesser extent, maybe Vietnam or that sort of a thing. And in fact, Michelle, if you can go to, I think it was the third or fourth slide. So, yep, maybe right there. Let's go back to one more. So it's right at the beginning. So talking about India. So down at the bottom there, the second row from the bottom, so you have, China, India, Brazil, and just interesting to see from a global economic activity standpoint, while the rest of the global economy seems to be slowing, India seems to be flat out foot on the accelerator. So how do you see supply chain shifting? How do you see that maybe changing the world's relationship with China? And to what extent does having supply chain shift to India, which is more of a democratic nation versus a communist nation like China, what impact does that have on the global economy?
So there's a lot there, so let me try to unpack it for everybody.
A lot there.
The first thing I'll say is that it's really just about the diversification of supply chains, right? The problem that people got into, the trouble that people got into during COVID was that they relied on a single provider or a single producer. And when that producer or provider became inaccessible, right, they were completely frozen. And so, I go back to, this was years ago, I saw the CEO of Cisco being interviewed at Davos, and he was talking about how Cisco's supply chains ran through 48 different countries around the world. Right, that's going to be the name of the game going forward. It's going to be a little bit about onshoring, but also more so about diversification and not solely relying on China when it comes to certain types of inputs. Right, semiconductors are front of mind, and the reliance on Taiwan. We're going to diversify supply chains going forward. In terms of India specifically, so. Yes, people are going to India. We also see, to your point, a lot of people going to places like Vietnam and the other ASEAN countries, right? Indonesia, Thailand, so on and so forth. India is a little bit of a unique case because, yes, they are technically democratic, but a lot of the democratic reforms that got people excited about the India story a couple of years ago haven't necessarily come to fruition. And more recently, what do you see India doing? Well, you see them buying Russian oil. And so I think what's happening here is that we are entering a world of multipolarity, whereby on the one hand, we'll have countries like the US and Europe and the broader West kind of banding together, and probably more supply chains that run through places like Mexico going forward, if I'm being honest. And then on the other hand, you have this other pole in the global economy of China, India, Russia, so on and so forth. And so, the supply chain story is going to continue to evolve. I think the name of the game is going to be about diversification. And when it comes to India specifically, we will continue to see people, move there and set up operations there. But we're not necessarily as confident that India is kind of this silver bullet, democratic, capitalist story that a lot of people were really excited about a couple of years back.
It is interesting just seeing even earlier this week, I think the population for China has fallen for the first time in decades, whereas India's population is certainly growing. I think the average age in India is like early 20s versus the average age in China is much older. Part of that being due to their one-child policies and some other some social policies that they had implemented there. So it'll be something to keep an eye on. We've had a couple of questions come in, David, on specifically the topic of sectors. So one question is, are there particular sectors of the equity markets that look particularly attractive? Another question is, what do you see as the strongest market sectors in 2023 or the weakest? So two questions there specifically having to do, and maybe that's just the US economy, but sectors you like or sectors you would stay away from?
Sure. So the sectors that we like are those that we think can continue to grow earnings against the macro backdrop that we see playing out. And so for us, that's a lot of sectors and industries that tend to have pricing power. So energy, materials, to an extent, consumer staples, parts of the industrial complex. I mean, the airlines, right? They just reported earnings, and what they said was we raised prices and people paid. And so we like those types of businesses in the current environment because we think that they can defend their margins. At the same time, when we look at some of the more profitable parts of the growth complex, the sell-off last year was concentrated in things like technology, and some of these, large profitable technology names are now beginning to look more attractive. So what I would say, people always ask growth versus value. It's really a combination of the two. We're finding things to do on the value side. And interestingly, those are businesses and industries and sectors that look like they'll be able to grow their earnings pretty well. And then when we look at the growthier side of the book, that's actually where we're seeing the value. So we like value for the growth and growth for the value, as silly as that may sound. Where we want to be careful and where we are trying to avoid deploying a lot of capital is going to be in things like communication services, some of the less profitable parts of the growth complex. We think that interest rates are probably not going back to zero anytime terribly soon. And those were companies that really needed, an environment of free money in order to thrive. And so we're going back to basics. For us, it's all about the cash flows. We want to see stable, durable cash flows, and we don't want to overpay for them. We're playing it pretty close to the chest here, at least to start in 2023.
So companies with cash flows, and not necessarily some of the high PE startups or that sort of thing, but also balance sheets might play into it because, as you mentioned, interest rates not going down to zero anytime soon. So if you're a net borrower and your borrowing costs are going up, that's bad, versus if you're a company with a strong balance sheet and you've got surplus cash, which you're getting higher interest rates on, then that's good. So balance sheets as well as cash flow may factor into your thoughts.
Exactly.
Yep. Okay, great. Let's shift and chat a little bit about labor and specifically employment or unemployment. One of the things that our own research has identified is that there's not ever been a recession when the unemployment rate is below 5%. So that's something I'd be interested in your comments on. And then we've had some questions come in. One question in particular: at what point do economic forecasters pay more attention to the labor force participation rate versus the unemployment rate as a more meaningful watch item? How much is the labor force participation rate skewed by boomer retirements versus other structural issues?
So what I would say about the unemployment rate, and then I'll talk about the participation rate, I would agree with what you guys, with what you just said, right? It's very rare to see a recession with the unemployment rate below 5%. The risk is that when the unemployment rate starts moving, it can be difficult to get it to stop. And so, we could overshoot, but I think from our vantage point, the thing that we try to impress upon clients and investors is, we don't necessarily need to see the unemployment rate go to where it did in the aftermath of '08. I graduated from Williams in 2009. It was an economy with a 10% unemployment rate. It was nasty. You could not find a job. I don't think we're going there. I don't think we need to go there. I think the Fed just wants to add a little bit of slack back into the labor market to cool off that wage dynamic. Now, to the question of participation rate, everybody yelled at me for the 10 years after '08, telling me the participation rate was too low, and then it moved even lower during the pandemic. We estimate that about 2/3 of the missing workers, if you will, were due to retirements, right? People who looked at their 401ks and said, I think I'm good, and they just chose to walk away. There are other issues that are impeding labor supply, some lingering health concerns. A skills mismatch is a big one, right? The people who are looking for jobs aren't necessarily qualified to do the jobs that people are hiring for. And then again, other kind of, lingering issues like childcare, so on and so forth. And so we do think that some of this labor supply will gradually come back, but those retirees are not coming back anytime soon. And what the real issue here, right, is not about the number that is the participation rate. It's about lack of growth in the labor force. Because if you decompose economic growth into its drivers, economic growth is basically a function of growth in your labor force and then growth in productivity. And there are only two ways to grow your labor force, right? One is to do it organically, but that basically takes 18 years to make a worker. The other is through immigration, which there isn't a lot of appetite for legal immigration reform in the current environment. And so I think that over time, we need to figure out how to get that participation rate back up to where it was really prior to the financial crisis. But it's not clear to me that there's a single lever that we can pull, which is going to get us back there overnight. And so I think we're going to be dealing with more of the same. But again, that lower participation rate also leads us to believe that the unemployment rate doesn't need to move as much to the upside in order for the Fed to get what they want in terms of some slack reappearing in the labor market at large.
Let's pivot from those comments, David, and let's talk a little bit about the Fed. You chatted a bit about the Fed. It said that it takes, maybe 6 to 9, some people would say 12 months for the economy to manifest changes in the Fed funds rate. And of course, last year we started with a single quarter point, then a 50-point, then 4 in a row 75s, which if I just add up that, I've got 5 times 75, if you include the first 25 and then 50, and then wrapped up the year with a 50 basis point increase in December. So the Fed has significantly increased interest rates over the course of the past 12 months. How much of that are we feeling already versus if it takes 6 or 9 or 12 months, let's even just say 6 months, we're really only feeling maybe 150 basis points of increase versus the entirety of the increase from last year. So how do you see that? How do we experience that going forward?
So I think that you're beginning to feel the lagged impact of shifts in Fed policy in things like employment, right? The kind of cooling that we're seeing in the labor market. Microsoft has been in the news for shedding 5% of its labor force. Amazon's been in the news doing similar things. Goldman's been in the news doing similar things. And so, I think that's really a function of what the Fed did and that beginning to rebalance aggregate supply and aggregate demand, where I think you actually saw the impacts of Fed tightening show up, effectively overnight, were in places like housing and the interest rate sensitive sectors, because when the Fed started to go, long-term rates went to the moon and mortgage rates went north of 7, which made a lot of the housing market simply unaffordable for the average American. And so there were certain areas, the rate sensitive areas, that saw the impact of that shift in Fed policy again, effectively right off the bat. But I think what we've begun to see here over the past couple of months is exactly what you suggested, the lag impact of what the Fed started to do back in March of last year. And in our view, that's only going to contribute to a further slowing in growth here as we work our way through the first part of 2023.
On the Fed, we've heard it said, and I think it's a valid point, that by the Fed raising rates, one of the things they're trying to accomplish is basically to squeeze borrowed money out of the system. When money was cheap or money was free, you could borrow money for nothing and then deploy that money, and whether it was, to your point, housing, or whether it was for business expansion or that sort of thing. So with interest rates moving higher, there's a lot less borrowing going on, which is in fact slowing the economy. What are your thoughts about the idea of the Fed, per se, squeezing borrowed money out of the system by raising rates?
So I'm not sure that in and of itself squeezes money out of the system, right? I think that them allowing their balance sheet to run down is what removes that excess liquidity from the system. I think what the Fed has done with rates, right, is shifted the incentives around borrowing, right? If you're thinking about, let's just use housing as an example, right? You can afford a much bigger house when rates are at 3% than when rates are at 6%. And so, if you're going to be swinging for the fences, you're going to do it at 3 and not 6, and you're not going to overextend yourself when the interest cost of borrowing becomes prohibitive. And you layer on top of that, right? So the Fed, again, what they're trying to do is rebalance supply and demand. They're trying to slow the pace of economic activity. They're trying to reduce, again, overall demand. And the way that you do that is by making financing more difficult to come by. The problem in the aftermath of '08, when rates were at 0, was you could throw money at any idea and it would stick, right? Because there was no cost of capital. The reality here is that having a cost of capital actually creates differentiation between winners and losers. That means that capital flows to the more attractive projects, but the stuff that's just junk isn't going to get the financing. And so, whether that's a second vacation home, whether that's a young, unprofitable tech company, right? The list is long and distinguished. But the bottom line here is that by increasing the cost of money, right, the Fed is indirectly making it more difficult for people to go out and spend in excess of their income. And that in and of itself should slow the pace of economic growth.
Versus, so say, for example, as interest rates go up, you're going to borrow money really only to finance good ideas, versus when money was cheap or free, there were a lot of dumb ideas that got financed, so there was, to your point, some differentiation or distinction. David, I appreciate your time. I'd like to kind of shift as we draw towards the conclusion, and I'd like to shift towards housing, and both housing and then housing's impact on inflation. So you talked about the affordability of housing, and that, housing, if you will, was more affordable when we could borrow at 3% versus being able to borrow at 7% made housing less affordable. It's an interesting phenomenon because when you could borrow at 3%, you would get, the house would go on the market, and in the course of a weekend, you would get 20 offers, right? There were so many offers for every individual house that was for sale. And so in that context, it was said that housing was not affordable, especially for entry-level buyers. A lot of, per se, investors were coming in with cash or were coming in with, cheap financing, and first-time home buyers were not able to afford housing because interest rates were so high and there was so much competition. Now, interest rates are higher. You're not getting 20 offers in a weekend, and we're being told that housing is not affordable because interest rates are so high. So it seems like, you're darned if you do, darned if you don't kind of thing. Which would we rather have? Housing that's not affordable because of high interest rates, or housing that's not affordable because there's too much demand? Or maybe there's a different answer.
So, I think the real question is where do home prices go over the course of the next couple of quarters? And, when you look at where home prices have increased the most, right? It's not in the tri-state area. It's not in the Bay Area. It's not outside of Chicago. It's in places like Dallas and the Sun Belt and Austin and Scottsdale, where you saw a massive increase in supply a lot of that financed by the investment management firms. And, that list is long and distinguished. We're a part of it. And you saw people that were loaded up with cash because of what the government had done from a stimulus perspective. And so they thought they could buy that second home, or they could reach and buy that bigger home. But the problem is, those are the markets where as the labor market begins to soften, those are the markets where, a lot of the employment is in low wage service jobs. And so the bottom's going to start to fall out. Those prices are going to correct. Interest rates move in cycles. Right. So if interest rates are too high today, just wait, because they'll go back down at some point, down the road. I think the bigger issue is that, right, home prices can be sticky and home price declines are somewhat rare. And so what we really need to orchestrate here is a decline in home prices in those areas that were running too hot to begin with. And that's going to be what makes housing more affordable. The financing will take care of itself, right? The Fed's not going to keep rates where they are forever. So we need to bring down those prices. Otherwise, those homes are going to remain out of reach. Because again, in aggregate, it's very rare for home prices to decline at the national level.
Sure. I mean, obviously, 2007, 8, 9 was maybe an example of that not being true, but I don't think any of us want to go back to a situation like that. It's said that the cure for high prices is high prices.
Right.
Meaning that high prices will either decrease demand because people don't want to pay the high prices, and or it will increase competition because if the prices are high, then more competition comes into the market to make that profit, if you will. So the cure for high prices is high prices. Just give it a little bit of time. Let's wrap up. I want to go back to slide number 10, which is specifically having to do with inflation. And just on this topic of one more. There we go. Let's go down. I'm sorry. On the bottom left-hand corner, 7, 8, 9, 10. One more. It was the one that had the different components of inflation. I thought that I made a note of it.
It's right before the Fed funds chart. So just go 3 slides forward, and that should be it.
There you go. That's it. So on the left, I thought this was an interesting chart. I had the opportunity to preview your slides ahead of time, but talking about inflation and breaking it down between energy and vehicles and food and shelter. And the bottom, the darkest blue at the bottom there being shelter. And it's my understanding, if you could confirm or correct, that of the CPI, which is the most common inflation number, that 1/3 of the CPI is shelter costs. And so if we want inflation, as measured by CPI at least, to come down or to moderate, this is where housing is so important. This is where, for say, the shelter costs and what you were talking about of the people who own their homes are not renting their homes, right? So if you wanted to just maybe, as we wrap up, talk a little bit about this. If CPI is 1/3 housing, then housing is such a critical component of inflation and trying to bring inflation down. And to your point, housing tends to be a little sticky. It's maybe a lagging indicator. We don't really see house prices come down. I don't know if we see apartment rents come down. Doesn't feel like that's been the case recently. So how do you see housing and the components of housing playing out as it pertains to inflation? And then final question within the question, the Fed said their target is 2. I've heard people comment that maybe 3 is the new 2. And so at what point does the Fed get comfortable and say, hey, 4 is good, 3 is good, we're on our way to 2, and we can start easing? So we'll just there's a lot there, David, but if you want to speak to housing and inflation, and is 3 the new 2, and when does the Fed get comfortable?
Sure. So I think the Fed gets comfortable when inflation has moved close to 3%. I'll give them a little wiggle room on either side, but at 4, they're not going to feel like they've accomplished their mission. They want to know that inflation is continuing to decelerate, continuing to move lower, and closer to 2 than 4 is kind of the way that I think about it. On the housing thing, I'll go back to something that was said to me when I was an undergrad, which is that inflation doesn't measure level, inflation measures rate of change, right? So if you own a house, right? And your house at time zero cost $100, and a year later your house costs $200, right? Home price inflation in that year was 100%. If the following year your home still costs $200, inflation's back down to zero, right? So it's really just about being patient and allowing this to work its way through the system. The pace of increase in home prices has subsided significantly. And so, again, to your point, it's going to take time, but based on our views of what's happening in housing, and this is exactly what the Fed wanted to happen in housing, right? Home prices aren't continuing to skyrocket. And so that dark blue portion of the bar should gradually begin to decline. At the same time, we are seeing evidence that rents are rolling over. The thing with rents is they can be somewhat slow to move because people only sign leases every 12 months, right? So the bottom line is that we need to be patient. And again, the big risk is that the Fed gets impatient and fails to differentiate the inflation that's coming from other parts of the economy versus inflation that's being, directly propped up by what happened in housing.
And so that's where the risk of overshooting in terms of the Fed, because you're dealing with lagging indicators in terms of housing and home prices. Interesting, again, to look at your graph there and see red, which was new and used vehicle prices. Certainly, because of supply chains, you couldn't buy a new car, and they were selling them for over MSRP, and then used cars were almost more expensive than new cars, and that has changed drastically, it seems like, in the last 90 days. Used car prices are really coming down. New cars, there seems to be an abundance of them. So it's interesting to see in your, last bar chart there that red's not even on the chart anymore. It's not there. So certainly there are factors. I think one of the points that you made that I'll highlight is just comparisons or comps, or compared to what. And so, hey, if prices went up 100% last year, and this year they don't change, then inflation is zero. And so it's compared to what? It's compared to a year ago. And so whereas you have auto prices coming down, you have home prices moderating. And so to the extent that that is already in motion, those things are already happening, I think that's where there's the concern sometimes that there's a potential policy error with the Fed, that they may overshoot because these things are already in motion, they're already happening. There's the 6 to 9 month lag between a Fed interest rate and when it manifests in the economy. So it'll be interesting to see. Stay tuned. Stay tuned. Well, David, we really appreciate you spending your time with us. We love JP Morgan, and Ben Karbowski is sitting in for Chris Gales, who is waiting his own baby being born. So congratulations in advance to Chris, and Ben, thanks for sitting in. David, thanks so much for spending your time with us and sharing your knowledge and expertise. And please give our very, very best also to David Kelly. Again, this is Ward Keever and Michelle Fisher, Covenant Wealth Strategies, our Stone Barn Speaker Series virtual. And we are honored to have David Lebovitz from JP Morgan Asset Management. Thanks so much. Have a great rest of your day.
Thanks, everyone.